Hi everyone. So today I'm going to be covering a new company called DoubleVerify. It's a smaller company. It has about a $2 billion market cap. So let's get right into it. Let's see their earnings and everything else and what they do as a company first. So I'm going to go ahead and share my screen and we're going to take a look and review it. So they are a software platform company based in New York City. They provide digital media measurement data and analytics for advertisers and publishers. Its purpose is to ensure digital ad placements are secure, effective, and free from fraud. The core of its service involves verifying that an ad is viewed by a real person in a suitable environment and in the intended location. This is really for companies making sure that they have a return on investment or ROI. And you could see that right here, performance optimization. Using AI, Double Verify helps advertisers maximize the effectiveness and return on investment ROI of their media spend by measuring and optimizing campaign outcomes. They do have ad fraud protection, like I said, and pretty much more or less, I would say that a lot of the bigger companies were using them, but a lot of the other bigger companies, like Google, for example, has their own ecosystem now, and you're going to see that in a second why the business model is facing a little bit of a problematic or troublesome time. But we'll get into that in a second. Anyway, so for publishers monetization support, Double Verify helps publishers maximize their ad inventory revenue by providing data and tools that attract more advertiser spending. You have another addition to it, which is they have a proprietary accredited metric called the authentic ad to be counted as authentic. An ad must meet four standards: reviewed by a real person, it is brand suitable environment, is delivered within the intended geography, it is fully viewed. So more or less, it seems their competitive advantage that someone is actually looking at it. It's not just some AI program, which tends to be very interesting. However, if we check the earnings are good and they're not good. So for the second quarter of 2025, Double Verified revenue of 189 million, a 21% year over year increase, which beat analyst expectations. However, the company missed EPS estimates. Revenue, you have an increase, like I said, 21%, adjusted EBITDA up 22%, net income 8.8 million, but they missed the EPS by a cent, which I don't think that's too big of a deal. Double Verify saw significant growth across its main revenue streams, including activation, measurement, supply side. The company continues to expand its presence to high growth areas like social media and connected TV, CTV. Of course, there are new partnerships. And for the third quarter, following the guidance, they think there's going to be revenue between 188 million to 192 million, adjusted EBITDA to 60 million to 64 million. The company also raised its full year revenue growth guidance to approximately 15% year over year. So that right there is a bit problematic for me because the company has been significantly getting less and less, had have these incredible outsized returns. And we're going to see that down here because I actually asked Gemini. The revenue growth is slowing down. Yes, Double Verify has experienced a slowdown in revenue growth. And as you can see here, 2021, 36% revenue growth, 22%, 36%, 2023, 27%, 2024, 15%. And now 2025 was 10%. Now it's going to be 15%. So again, so it's more and less, of course, this is a natural thing of companies. And you could even go back to 2019, it was 75% revenue growth. So, that's the problem with these companies is that what's what's happening is not really great. And we could see here the factors contributing to the slowdown, which is customer spending. Some of Double Verify's largest customers have significantly reduced their spending, impacting overall revenue growth. A major customer cut approximately over 20 million in 2024. Six other large customers also reduced their budgets. Walled gardens. The shift of advertising dollars from the open web to walled gardens like social media platform poses a challenge for Double Verify. Their solution were not initially available on these platforms, and while they are expanding their presence, catching up requires time and effort. Pricing power. There are concerns that Double Verify may have limited pricing power. Macroeconomic concern. Of course, there's that. But the walled garden thing, I think, is the most important because, of course, something like YouTube or Google, Alphabet, YouTube, it's going to be considered a wall garden. Apple, Amazon, all the big tech companies, Meta, they all have their own wall gardens nowadays. While the long-term trend indicates that Avera has shown resilience, the revenue grew 21%, following a 17% increase in Q1. This led to a slight upward revision. to 15%, like I said. However, the updated full year guide still implies a deceleration in the latter half of 2025, which projected growth around 10%. This suggests that challenges remain and the impact on customer spending projections might be more pronounced. So you have to be a little bit careful of that. Anyway, so let's check Simply Wall Street. And Simply Wall Street's going to say that currently it's at 149 million, and the next 3 years is going to be 215 million. So not great. Obviously, you could see that what they're saying is accurate. It's not a double like I've seen before. It's definitely growing, and you have to be just aware of that. And you could see also here, we could go back all the way to 2022. So that's about 3 years ago now too, 47 million, and now it's at 149 million. So that's a great return on investment. That's about a triple in free cash flow growth. That's really good. Really, really good. But obviously now it's slowing down. If we check the financial health of the company, the financial health, very good as well. You have cash, no debt, a lot of equity, perfect, nothing to complain about here. Now, if we check the previous few years, like I said, 73 million to 149 million, did very well, right? If we check my DCF here, it's going to say that it is undervalued by 35% based on historical growth, but the historical growth is using 26%. Wall Street forecast is using 10%, right? So if we look at Wall Street forecast saying it's overvalued by 26%. So maybe I think it's somewhere in the middle, somewhere along the lines of the middle. Because lastly, if we check Tipranks is going to say that is a moderate buy. There are 11 buys, 4 holds, 15 ratings, upside 54%, which is great. Current price is $13 a share, and a low 17 average of $20. So in that sense, it doesn't look that bad, but you do have to be a little bit careful on this company because, of course, the analysts updated it and earnings did come out in August 5th. So you do have to be a little bit careful because growth is slowing down. So this might be more of a value play than a growth play. But just keep that in mind if you're interested in this company. All right, everyone. I appreciate it. Thank you.